Sandip Agarwal, Fund Manager and Co-founder of Sowilo Investment Managers joins in. Sandip, hi, thank you very much for joining us. Give us a sense on how you're seeing the IT space, because the space has registered significant gains in the last few weeks. It's on the buy call of every fundamental and technical analyst right now. Earnings also were not bad, largely more or less positive, I would say. Do you feel like the good numbers have trickled in? Do you think it's time for IT to make a comeback? Is it already in the process of making a comeback? And are you a lot more comfortable today with this space?
Yeah, hi, thanks, and good morning. Thanks for having me on the show. So, if you recall our multiple conversations which have happened in the past, I think the sector has started making a comeback almost 6 months back. And this sector is a very typical sector which generally moves in a lag effect with the US big techs. And if you see, the big techs were doing quite well in terms of reporting numbers for last 5 to 6 quarters, and our industry was not doing well for last 8 to 10 quarters, which started with a very high attrition. TCS witnessed a 29% attrition few quarters back only. And with, in last 6 8 quarters, you would have seen that our attrition has now cooled off substantially. Now it has come back to the slightly below normal level. And that has triggered the higher margin this quarter, which you witnessed. And in my view, in this quarter, again, you will see a positive surprise from all the tech companies on the margin front. As far as revenue front is concerned, last 6 8 quarters have been muted. So you will see 2 3 quarters of good year-over-year growth. But let me reiterate, the global IT services outsourcing piece grows at 6 7%, and we grow at 8 9% because we gain some market share every year, and that gain of market share is also very very minuscule, because we are almost like having maximum of that. So I think this is a sector where you should look at 8 9% kind of revenue growth and 11 12% kind of profit growth. And if 1 or 2 years the returns are not coming, then you can be rest assured that the third year everything will get clubbed and come together. So I think we are in that situation since last 2 quarters, because prior to that the sector has not given any return. Now in last 2 quarters we are seeing more than 15% return for most of the companies, and I think another 10% is something which I believe will happen in the services space. So we are very comfortable in the large names which are reasonably priced, like the HCL, Techem and all. But in the mid cap, the IT services, I am not very bullish, because they have never corrected and they are still expensive. ER&D is obviously a different story. ER&D is a structural 10 15 year story, and it can grow at double the rate of IT services. So obviously the multiples are high. So I would rather, look for large cap which are reasonably priced, and in mid and small cap, if I can get a play on ER&D at a reasonable value, that is what I would like to play. And because we run a PMS, so very hard to call out names, because our client and we may be holding something, so very difficult to call out names, but the broad framework should be like this.
Right. In the large cap space, and it's largely legacy businesses, legacy clients, which some may argue are making a comeback. Now, this whole space was threatened with the threat of AI. Some analysts argue that that could have been overdone in terms of what this is going to do to the legacy businesses. Is that the reason why you feel like maybe large cap names like a TCS and HCL and Infosys may provide better risk reward?
So in the large cap, there are a few points of comfort. First of all, if you see, they are sitting on very huge cash. They do buybacks. They have a stable management team, and having said everything, 10-12% EPS growth on a consistent basis is not at all bad, and that minimum requires 2.5 times PEG ratio, and I think we are there. Multiples are close to that. Like the large cap good names are between 22 to 30 times, and I think it is a reasonable value, considering that these are the names which will keep on giving you 10-12% earnings growth for next 5-10 years comfortably. So I don't see a challenge from that perspective. But yes, that every time when technology disruption happens, I have seen 5 in last 25 years, people write off the Indian IT services sector, which is not correct. You have to remember, we provide manpower, so we already are doing some work which becomes legacy when new technology comes, and you have to service those clients who are using your legacy service, and you have to build on capability for new service at the same time. So there is a transition period of 3 4 5 quarters when you have to train workforce into the new technology, and that is a period when we go through pain. And because of AI, we have gone through that pain for almost like 6 quarters, and then last 2 quarters we have seen recovery. We will see good recovery next 2 quarters also.
Right.
All right. Well, Sandeep, a question also on the many managements that we've been talking about. And of course, two questions would be, one is the potential of interest rate cuts coming forward in the US. And secondly, whether or not a political regime change in the US could impact how business could pan out in terms of environment in the US going forward.
So interest rate cut has always been positive for Indian IT services, particularly because whenever interest rates cut have happened, there the client budgets have opened up in a more bigger way, and it has always helped. So I think that benefit is yet to flow, which will flow definitely in next couple of quarters. As far as I would also believe that while politics is there and internal matrices are there for every country, but the reality is that if you see last 20 years data also, there has virtually been never any unemployment in US tech side, basically, except that 1 month of after Lehman crisis. Every time there is a shortage of manpower in the IT services side. So I don't think that even if you make some changes, it will basically hurt the US consumers only, the corporates only, because they will end up paying more money because they need to get work executed, and the price arbitrage today is also 3 to 4 times minimum, and on top of that there is no one available. So the challenge is that even if you restrict things, if you bring some tough legislation on this front, you have to remember that the manpower is available only from India, and toughening will only increase the price. So I don't think it has in last 20 years many attempts have been made. It has not never been very strongly implemented. It's difficult because, and secondly, technology is a global thing. You can't restrict it into one geography or the other.
I know, I mean, valuations really doesn't stand in a market such as ours where everything is supposed to and looking so good. A couple of questions, right? What happens to FY26? Because in FY25, we've seen single-digit growth, maybe 3%, 5%, but do you think it's realistic to expect a double-digit growth for FY26? What is it that you're penciling in? And I ask you because some of these counters are trading at 15, 20 times 1 year forward. So is that even fair in my defense?
No, I think FY26 will be a very good year because of a couple of reasons. Right now, just recovery has started for Indian IT services in particular. So another 1 or 2 quarters there will be some recovery, but base will not be such that it will be a hindrance to the next year number. So I think FY26 is the year where you will see 8 to 12% revenue growth, and you add something on the margin front because attrition has fallen very sharply. So I would say you add another 3-4% on the earnings growth side. So you will see 12 to 16% kind of earnings growth for next year for the sector. And I think based on that, the valuations are not much stretched in my view. Obviously, there are pockets where, particularly in the ER&D space, where the growth is also phenomenal. Margins are also holding up. So there, multiples are little unrealistic, and they will, in my view, remain unrealistic for a longer term because the sector is on a structural uptick.
All right. Well, based on that, Sandeep, how are you placing stocks on your list in terms of preferences at the moment with the way things are right now?
So if we speak particularly on the IT services space, we are playing 1 or 2 large cap names because they are reasonably priced. There is a good dividend and all. And we are looking for ER&D companies, small ones, which are not much attention is there, which are trading at a cheaper valuation. Obviously, they are not delivering the kind of revenue and margins they should. But that is the time when everyone is pessimistic. That is the time we should pick up, because investment means that you have to wait. You have to wait for the business cycle to turn. You have to wait for the business to turn. You have to wait for the leadership to deliver. So we are investing little ahead of time, and it may hurt us in near term, but I think in next 3 to 5 years, phenomenal return could be made on those names. So that is one way. Secondly, I think, we believe that the bigger theme is also AI. And unfortunately, in India, there is no direct AI play. We don't have NVIDIAs. But in my view, a good proxy for that is probably power. You have to play the whole power chain to get the benefit of returns on the stock from the AI perspective. So that is what we are using as a proxy.
All right. And well, moving on, Sandeep, just want to perhaps better understand the current rift between the mid-cap players and the small-cap players, the clientele that both these, these sub-segments are dealing with are completely different with respect to requirements, with respect to the different challenges that they actually have to undergo. How are you placed based on what you can foresee, at least in the near term?
So we always, actually the way we play is we never differentiate between large, mid and small cap. When we choose stock, we choose the capabilities and the segment we are trying to play. So right now we are trying to play ER&D through, and within ER&D, whichever is available at a reasonable value, we try to play that. In IT services, I think on the outsourcing, pure, data-based, very boring work type of companies we are trying to play, because those are only available at a reasonable price. The rest all good companies, good names, and they are all trading at 40-50 times forward. So it is impossible for us to pay that kind of valuation, because we are a value fund. We don't want to get into that high growth, high multiple thing.
All right. Okay, there you have it, Sandip. On that note, thanking you for joining us and giving us your perspective on the IT industry. Of course, the next few months are going to be very, very crucial because of the impending and high probability chance of, well, seeing rate cuts in the US, and of course the all-important US elections as well. Let's see where that takes things for the Indian IT sector.